All right, welcome to The Explainer. Today we're digging into a really interesting article. It's all about the hunt for high income for your portfolio, but with a twist, looking way beyond the US border. So right out of the gate, the article throws this huge number at us. Yields over 11%. Yeah, 11%. And anytime you see a number like that, it's going to grab your attention, right? But it immediately makes you ask a pretty big question.
Is this for real? Like, are these yields actually possible to get and hold on to? Or is it just a classic trap, the kind that looks too good to be true and then, poof? That's the big question, and that's exactly what we're going to unpack. Okay, so to even find yields this high, the article says, hey, you got to look outside the US. We have to shift our focus, and it points us to a specific kind of investment vehicle. It's called a closed-end fund, or a CEF for short, that specializes in global markets.
So why go global? Well, the author gives us three pretty solid reasons. First off, it's about diversifying your cash flow, so you're not putting all your income eggs in one basket. Then there's the chance to find better deals. We're talking attractive valuations, maybe even buying funds for less than what they're actually worth. And finally, you get to play in different economic sandboxes. Not every country's economy moves in sync with the US, which can be a huge advantage. And to make this whole idea really concrete, not just theoretical, the article focuses on two specific examples. We've got AWP, which is all about global real estate, and then we have FAX, which is focused on bonds from the Asia Pacific. So two very different funds, both playing this global income game. All right, let's get into it. Okay, first up, the Aberdeen Global Premier Properties Fund. You'll know it by its ticker, AWP. And its job is pretty simple, really. It's a one-stop shop for owning property stocks from all around the globe. And here it is. That big number we were talking about. According to the source material, this fund was kicking off a distribution rate of around 12.5%, and get this, it's paid out monthly. That's a serious cash flow. So you're probably wondering, how on earth do they get a yield that high? And this is where it gets really interesting. It's not just from collecting rent checks. It's actually a mix of three things. One, they have a managed payout policy, which kind of smooths everything out. Two, the fund itself is often trading at a discount. And three, they use a bit of leverage. Think of it as borrowing to invest more, which can really juice the income.
All right, let's switch gears to our second example and see how the story continues. This is the Aberdeen Asia Pacific Income Fund, ticker FAX. So we're moving from property stocks to bonds, and we're zoning in on a specific region. And you're not going to believe this, the distribution rate here was even higher. We're talking around 13%, also paid monthly. So you can see the theme here, right? We're talking about really high, really regular income streams. And what's cool is that it uses a really similar playbook to get there. That huge yield comes from the fact that the fund was trading at a pretty big discount. We're talking 7 or 8% below its actual asset value. Then you add in the higher interest payments you can get from bonds in that region and, yep, you guessed it, a little bit of leverage to magnify the whole thing. So all of this brings us right back to where we started. That all-important question. When you see yields this big, you have to ask, is this a legitimate tool to add to my portfolio, or is it just a trap waiting to spring? And I love this. The article itself just comes right out and asks it. It doesn't dance around the issue. But aren't double-digit yields a trap? That's perfect, because that's what we're all thinking, right? It tackles the biggest skepticism head-on. And instead of just giving a simple yes or no, it actually gives us a framework, a three-step process to figure out the answer for ourselves. This is super practical. Okay, this is probably the single most important thing to get. That distribution rate number, it's not the same as profit. It's not a yield in the way you might think. It's just the total cash the fund is handing out. And that cash can come from a few places. Actual earnings, sure, but also capital gains. Or, and this is the big one, it could just be them handing you back some of your own money. That's called return of capital. So it is definitely not a guarantee. Okay, so now that we know what these numbers mean and what the risks are, how would you actually use something like this? How does it fit into a real-world portfolio?
Well, the article lays it out with this great side-by-side comparison. It shows you they're basically two different tools for two different jobs. AWP with the real estate stocks is kind of an equity income play, but FAX with the bonds is more of a diversifier for the bond side of your portfolio. Different assets, different risks, different roles. And then it gives us this sample portfolio, a kind of sleeve built with a hypothetical 100 grand. Now, let's be super clear, this is just an example for illustration. It is not investment advice. But look at what it does. It mixes our two high-yield funds with something it calls a core ballast. That's just a fancy term for more stable, less risky holding that acts like an anchor. It's a classic way to balance out risk.
So in the end, after laying out how it all works, the good, the bad, and the risky, the article puts the ball right back in your court. And that's the real takeaway here. This is all about a trade-off. Are you willing to take on the very real risks of global investing, things like currency swings, leverage, credit risk, in exchange for that potential extra yield? That's the question. And it's one that only you can answer for yourself and your portfolio.